Thank you, Anthony. Can you hear me and can you see my
Yes,
slides?
very clear, very clear.
Excellent, thank you. I've just got 5 slides and I'll probably just focus on the areas that have been less gone over by some of the other presenters. My focus is primarily around trade and when is it going to recover, and when it does recover, how is it going to look differently to what we've been used to. This first slide is just some context, some historical context. On the left-hand side is the trend of world merchandise trade volume. The blue line you can see is the trend 1990 up to the global financial crisis in 2008. You can see it knocked onto a lower trajectory, and then as we move to the right, we see the impact of COVID-19, and these are WTO's 2 projections, an optimistic scenario with the green line and a pessimistic scenario with the red line. This is non-containers and containers. And I think it's probably fair to say that these projections that were done in the first quarter of last year, if anything, we're probably moving towards the optimistic scenario, because I think at the start of COVID-19, there was perhaps a presumption that it would hit both manufacturing and services and demand for goods equally. And as the other speakers have highlighted, what we've actually seen is demand for goods has probably remained relatively buoyant. It's been the service sector that is most strongly hit. On the right-hand side is the picture for seaborne container trade. And there's a number of things to highlight here. The first is actually the rate of growth of seaborne container trade has been on a downward trajectory for some time. So if you look at the yellow figures, which are compound annual growth over the previous decade, you can see it dropping from 9.9 to 9.1 to 7.3, and then considerably lower in the most recent years. You can see on the right-hand side, those 2 columns are projections for what the 2020 ultimate numbers were and what they expect for 2021. The grey column is by Clarkson's, the light blue is Drury, the Drury projections being less pessimistic both in terms of downturn, but then equally on the upside, the recovery being less strong. The point to note here, as I said, there's a long-term declining rate of growth here for many factors. One, overall economic growth has been slower, but actually the multiplier has been slower. 1 unit GDP growth has delivered an increasingly smaller rate of growth in containers. In 1990 to 99, that multiplier was 3.4. 2000 to 2008, it was 2.6. 2010 to 2018, it's only 1.4. And that reflects many factors. One, probably a slowing rate of container penetration. So those goods that were break bulk or bulk and were converting to containers, that's largely been played out. But also probably an adverse sentiment and a slowing rate of globalization. So less of the big global trade deals, nothing of a scale to China joining the WTO in 2001. What we increasingly see are smaller regional trade deals like RECIP or CPTPP. And those trade deals are primarily between exporting countries. The real bang for your buck is pairing up a US or a Europe with a group of exporting countries. And then more recently, we started to see the impact of the US-China trade war. And so really the next question is, when demand recovers, is it actually going to be structurally different from what we've been used to? And on this slide, this reflects various surveys that were undertaken by EY and other parties around how people felt that supply chains were going to be restructured, both the trends that we've seen already underway, but whether COVID-19 was going to accelerate some restructuring of those supply chains. And really this is touching on the issue of, is COVID-19 going to accelerate a trend towards more nearshoring and reshoring and multi-sourcing away from China? Now, those 3 things could have a different impact. Reshoring is probably the most dramatic and would have the most impact on maritime trade. This, for example, would be a US manufacturer bringing all of its supply chain back to the US. Nearshoring would perhaps be that US manufacturer bringing it back to Mexico, for example. Multi-sourcing or moving away from a China-only model could see production both in China, but also in Vietnam and other parts of Asia, and could, of course, still require a large demand for container freight and movement of containers. On the other hand, there's a number of other points that would suggest this is unlikely to take place. The graph in the middle here is showing how embedded Asian production chains are with Chinese imports. This is the share of all imports of intermediate manufactured products coming from China in 2018. And it's showing, for example, that Cambodia, Vietnam, that the production and manufacturing taking place in those countries is heavily embedded and intertwined with Chinese supply chains. And that's a process that's been going on for many, many years. And you'd have to ask, how quickly can that be unpicked? Secondly, there's always a failure probably to acknowledge how much larger China is as a production base than any other location. There's always a lot of excitement, quite rightly, about Vietnam, but it's just on an entirely different scale to what is offered from China. Industry 4.0 is often quoted as something that would drive nearshoring and reshoring. This is advances in robotics, even in sectors that traditionally have been immune from high levels of automation and robotics, like textiles, are now showing unit cost of production in higher cost locations such as Germany that can be equivalent to what we see in some of the cheaper locations in Asia. We also saw during COVID-19 in the US, for example, interesting examples where car manufacturers would partner with medical equipment manufacturers to produce ventilators using digital printing, dramatically reducing the number of parts that were needed and producing that onshore in the US. Now, while those examples are interesting, the question is always, how widespread is that? Is that really going to be widespread? And finally, as a caveat, I'd say in that bottom right, when you're asking consumers about their willingness to pay more for goods that are not produced in China, for example, it's one thing if they're talking about saving a few cents on a pair of sneakers. It's entirely different if they're thinking of costs that could be 20, 30, 50% higher. And actually the data to date, as this graph shows, doesn't really show any evidence of this happening yet. On the top left are global export market shares, the red line being mainland China. You can see that peaking in January 2016, and then China's share starting to decline. The blue line is the start of the US-China trade war, and actually you can see even despite that, the trend moving back upwards. And then when we hit COVID-19, we see initial precipitous drop and then actually the share increasing quite dramatically. Now that could be a sort of a one-off factor around demand for PPE equipment and others, but also there's something more fundamental going on there perhaps. And you can see the same for the black line, which is Asia, ex-Japan and mainland China, that Asia is also increasing its share of global export market share. The graph underneath is similar to the one I mentioned earlier. It's getting at this notion of how entwined production is in various countries with imports from China or intermediate inputs from China. If you look at the three arrows, the first is Canada. And this is showing between 2017 and 19 that if you looked at Canadian exports, the components within that were accounted for by Chinese imports increased quite dramatically. Likewise, US imports that were being used to create exports from Canada. The middle is Malaysia. There you can see a slightly different playing out of this. Increased their dependence on China imports for their exported goods. US declined. US, which is the third column, is quite interesting, has increased its use of Chinese imports, but actually not as much as its dramatic increase for US intermediate goods for its exports. So, although that doesn't factor in what's happened in COVID, because this is pre-COVID, it highlights over the 2 years leading up to COVID-19 how increasingly important Chinese exported intermediate goods are for production capacity, not just in Asia, but around the world. The two graphs on the right-hand side are really highlighting, I think, something that Reuben had touched on, but also the other speakers, the difference between this downturn and the global financial crisis. This is US household consumption expenditure. You can see the global financial crisis having a major impact on consumption of goods. If we looked at January 2019 on the right-hand side, you can see actually the impact has primarily been on services. That also then will shape the nature of the recovery, because it's unlikely to be a roaring back of manufacturing and production, because actually that hasn't been that adversely affected. It's likely to be a recovery in services, and therefore you're likely to see the uptick in those economies say in Europe and the US, that have been most heavily hit because of depressing growth in their service sectors. The same here can be seen in export volumes. If you look at advanced economies and emerging Asia, these two lines here, both of them saw a dramatic decrease in export volumes during the global financial crisis. We have a very different picture during the COVID-19 crisis, with advanced economies seeing a dramatic fall in exports, emerging Asia less so. This is looking at some of the impacts for ports and terminal operators. I'll just pick on three things here. We've already discussed some of the challenges around getting containers into the right location, that we have too many empty containers left in Europe and Asia that need to get back for stuffing in Asia. In addition to the factors that both we and Andy mentioned, it's also important to know that actually container production has been down anyway. Container production, dry containers, the first half of 2020, production was 40% lower than it was in the corresponding year. Therefore, not only have we got a problem of circulating containers, we actually have fewer containers in the system than we would ordinarily need. The other 2 points I'd highlight are around digitalization. I think all speakers have highlighted how COVID-19 has probably accelerated the move towards digitalization to develop smart port ecosystems, smart trading systems that can improve resiliency, sustainability, traceability of goods within the supply chain, and reduce some of the need for human interface, person-to-person transfer of paper, etc., etc. I think one of the big challenges here is which parties can drive standardization, which parties can act as a neutral player, but also how do we avoid having a balkanization of standards with the US, Europe, China trying to set their own standards around these systems and make sure we have interoperability between them so that we have global integration. And then also on terms of decarbonisation, I think there was possibly a concern that as a lot of players in the supply chain became financially stressed, they would lose their interest in decarbonisation or climate change measures and focus on bottom line. I think it's very different, say, now than it was 20 years ago. Most of these initiatives are mainstreamed, and if anything, COVID-19 has actually accentuated our interest and understanding of how our activity affects the climate. And certainly, say at EY, we last year became carbon neutral, and this year we're targeting to become carbon negative. My final slide touches on the issues that Andy mentioned around what's happening for air freight. The graph on the right is just highlighting air freight rates, Frankfurt, North America, Hong Kong to Europe, Hong Kong to North America. You can see the steep rise in 2020, some decline, but still as we come into early 2021, rates are significantly higher. Even before we saw this constraining of capacity in air freight while also still having high demand, we had seen some evidence of modal shift from air to sea, not least as the quality of cold chain in maritime trade has improved. But I think COVID-19 has only exacerbated that trend. I think this is significant for air freight. The reason being sea freight offers just so much more capacity than air freight that it's possible for sea freight to take modal share from air freight. It's very difficult for it to work back the other way. So while this is potentially catastrophic for the air freight industry, it's less significant for sea freight. In terms of when this recovers, I think the other thing I'd add to the comments that other speakers have made is particularly what's going to happen to business travel. You can imagine scenarios where tourism and leisure travel recovers, but after we've seen the potential for remote working, are those premium carriers who depend on belly capacity for their air freight going to see the front of the plane recover? Because if that revenue doesn't recover, it's going to be very difficult to see a recovery in the air freight industry that's going to be broad and widespread. Even in a place such as Hong Kong, where we have a relatively high share of freighter services, there's still a desperate need for that belly capacity, and that's heavily linked to premium travel and business travel. So I'll leave it there, Anthony. I think that's my 15 minutes, and hand it back to you.